Hello everybody, welcome to GJAMES Associates channel. This is being Olatunji. Today we want to be looking at the financial statements. Basically, we want to introduce ourselves to fundamental about financial statements as we are looking at the broad topic or the broad course, financial accounting. So we'll introduce ourselves to the components in this video of financial statements. We will look at who are the people responsible for the preparation of financial statement. We will look at regulation in the industry, that is financial reporting regulations and accounting standards, looking at GAAP, looking at IFRS, that is generally accounting acceptable practices and international financial reporting standards. Then the key four areas which we can call for guidance from accounting standards we'll be looking at. Okay, so let us go in details into the subject of the day: components of financial statements. Components of financial statement. Basically, in accounting, when we are talking about financial statements or set of accounts, can be called set of accounts too. Basically, these are the components that we group as financial statements. So a financial statement must have a statement of financial position showing what stage or position the organization is at a particular time. The statement of profit or loss and other comprehensive income basically shows us how profitable or whether the organization is profitable or loss at a particular time. Then we talk about statements of changes in equity, which deals with the capital and the injection or outflow of capital or debasement of or erosion of capital. Then we talk about statement of cash flows, which basically deal with the inflow, outflow, the movement of cash, liquid cash in the organization. And last but not the least component that must be part of a financial statement is notes to the financial statement, which helps the stakeholders of the financial statements to be able to interpret it. So we call it notes to the accounts. So these are items that we must have when we are talking about components of a financial statement. At this stage, it's important for us to stress it that we should not worry now, because I know a lot of us hearing me now, we have a lot of questions in our mind. So all these are broader subtopics in financial accounting, and we shall deal with them as we continue and progress in this tutorial on this channel. So just by way of introducing us to components of financial statement, we are going to look at it in details, what's in each and every one of them actually are made up of. So we want to go into other parts and areas of financial accounting, which also are very important and germane to us to know. Introduction to financial accounting. When we are talking about financial accounting, we cannot but talk about double entry. First of all, we must talk about double entry. Every industry has its rule and regulation. Every industry has some values that they must uphold for things to work the way it should work. Likewise, in financial accounting, we have double entry, which guides us to keep records, interpret it, and make useful information available to the end user of the financial statement. So when we are talking about double entry, basically we are saying that for every transaction, financial transaction for that matter, there must be at least two parties to it, or there must be at least two entries made for that particular transaction. Let me give us an example of what I'm saying. If you buy something now, you must buy it from somebody. So there are two people now we are talking about, yourself and the person that you buy from. So if you want to record that you purchase something now, you will record it that you purchase, and at the same time that you've given the person the money, the seller, to you. So there must be two entries. Every transaction must have at least two entries. And even, let's say for example, we buy in credit. The creditor too is an individual, and we need to record it too, that we are yet to pay for it and that we buy something in credit. So that is what we meant when we are talking about double entry in financial accounting. Okay. The information recorded in the bookkeeping system, which the bookkeeping system and the like differences between bookkeeping and financial accounting, we've dealt with it in another video which you can look up for. The information recorded in the bookkeeping system, that is in our ledger entries and the like, is analyzed and summarized periodically, and the summarized information is presented in the financial statements. Typically, we are going to have some of the items that we've aforementioned. That is the 5 items that every financial statement will be made up of. So the financial position, statement of financial position, statement of profit or loss, and other comprehensive income, and every other thing. So we are going to record all this into these accounts or components of the financial statement. Then we need to talk about the objective. Why do we record financial transaction? What is the objective of financial reporting? Basically, is to make information, useful information for that matter, available to the end user, management, potential investors, lenders, suppliers, even governmental agencies, to make useful information available on behalf of the organization. Then also, by way of introducing ourselves to financial accounting, we must talk about an entity. An entity. So when we're talking about an entity, basically is a concept in financial world that an organization is an organism of itself, that is, has life of its own. An organization is separate from the owners or the owner, as the case may be. So that is what, when we are talking about an entity, that is what it means. An entity is a standalone body by itself, different and distinguished from the people that actually created the organization. Also in financial accounting, we must talk about period. When we are talking about accounting period now, we are talking about a year, a financial year that we can look at and say For the past 12 months, how are we done? How far have we gone, and things like that. So an accounting period is a timeline, it's a time period that we've set aside to look at our financial statement, to look at our financial position, to look at our financial transaction and business transaction, to see how far we are going, so that we can make amend where need be, and we can ensure that we are doing better and reinforce areas that we have done better or done well. So we will say financial period, or reporting period, or an accounting period. So as we continue, we know that some other periods that we have in the financial world, like tax period, is different from accounting period, but we are not making things complicated now. So, but we've spoken about double entry, we've spoken about entity concept, we've spoken about the financial component of financial statement. Last but not the least, we've looked at accounting period. So, who are the people responsible for the preparation of financial statements? Who are the people responsible for the preparation of financial statements? The question may be amusing to some people, because are we not accountants? I think we are responsible for the preparation. Is that not why we are learning here? We are about to know people that are actually responsible for the preparation of financial statements. For sole trader, that is sole proprietorship, that is, these are different forms of organization which we've dealt with before too. Partnership company, limited liability company, public liability company, and the like. So, but we'll take it one by one and digest it. For an organization that is owned by a person and run by a person, the sole proprietor, the business owner, actually has an obligation to himself or herself, to prepare the financial statement of our organization. And in preparing it, he or she is preparing it basically not to report to anybody, but it's good when we do that, so that we can take stock of our business transaction over a period of time. But by legal obligation, for sole proprietors, they are not legally bound to prepare financial statements. And basically, for us accountants, we are generally being employed to fulfill this obligation on behalf of others. We are actually fulfilling or taking that role on behalf of another. And that does not say that they are not still responsible for whatsoever we do, like agency contract. The owner might employ a person or persons to maintain the accounting record and prepare the financial statement, but they are responsible. So that's about sole proprietor. I want to believe we've learned something, and let me quickly recap it. Sole proprietors basically are not legally bound to prepare financial statement and present it, but it's good if they do, and they can do it by themselves if they have the knowledge of accounting, or they can decide to use or employ accountants and financial people to do it on their behalf. So for partnership also, which is not so far from a sole proprietor, there may be no obligation also for them to prepare, because it's more or less, it's closer to sole proprietorship. But if so, the partners are responsible, just like the sole proprietors are responsible to themselves. Partners in a partnership agreement organization are responsible too. to themselves to ensure that they prepare so that at the end of the day they will know what profits to share or if they've made a loss. Also, they too could employ people to prepare their financial statement for them. But for complaints, companies must prepare financial statements for the shareholders. And those that are running it, the directors must take responsibility for the preparation of the financial statements. And also the financial statement must be filed to governmental agencies and regulatory bodies. So therefore it is the responsibility of the directors put in charge to run and man the organization on a daily basis to ensure that this is done, that is the preparation of financial statements. So usually the work may be delegated to employees and accountants could be employed. But please know, fundamentally, as we are introducing ourselves to the general knowledge and principles of accounting, that we are employed, especially for accountants in employment, to work on behalf of somebody. That will not take the responsibility of the preparation, legal responsibility away from them. So don't see yourself as the person responsible for the preparation, because on the legality of things, that view is wrong. But that does not exonerate us, myself, yourself, when we prepare financial statements on behalf of any organization, not to have done a good job. Okay, let us continue. Who's responsible? We continue. The financial reporting by sole traders. Okay, this this is the notes of what I've just discussed with us. Let me see, maybe one or two things I can just pick. Okay, I've basically discussed everything that you need to know. So we move on to the financial reporting regulations and accounting standard. Accounting standard. And by the way, in this 21st century, a lot has changed. A lot actually has changed. So we are in a very regulated and a global industry, no more a local industry in which countries have different accounting regulations that are acceptable to them. But now we have globally acceptable accounting principles and practices. Now let's talk about international financial reporting standard. That does not mean that generally there are not some acceptable accounting principles. We have them, like double entry I just mentioned when we are introducing is still an accounting principle that is generally acceptable. But basically in this 21st century we find ourselves, and going forward, almost all countries in this world are aligning their financial presentation to international financial reporting standard to ensure comparison and global and intercontinental advantages for business organization. Okay, so regulation now has broken boundaries. Boundaries have been broken, even though they are still local or countrywide, nationwide regulators and body of accounting knowledge we still have. We have in each and every country. The UK have their own. In Nigeria, we have our own. Ghana has its own. Name the organization. Sri Lanka. Every organization. US. Every nation has their own. Okay, but nevertheless, now we are in a global village, and we have a global organization, a global regulation, and a global regulator that is regulating the financial reporting using international financial reporting standard. So accounting standard basically are generally acceptable all over the world and adopted all over the world. And if there are any conflict between the local regulation and international regulation, this what I'm about to say may be a bit above this level, but let me still say it because we are going to make the knowledge along the way. When the local accounting regulation or auditing regulation is in disparity with the international regulation, the rule is that the local will prevail, but the local regulator must quickly ensure that they ensure and work towards alignment with the global regulation. Okay, so that is about financial reporting regulation, GAAP, IFRS, accounting standards, and there are actually a lot of accounting standards depending on and some aspects of accounting that we are dealing with that will dictate rather which accounting standard we need to adopt. There are some that are common to all organizations irrespective of our industry, and there are some that are industry specific. Let me take for example IAS 1 about the accounting presentation is company wide rather. It doesn't matter the industry you have. There must be comparison between the last and the current year. There must be comparative figure unless the organization just exists within the first 12 calendar year, which we call accounting period. You remember that? Okay, we've talked about it. So apart from that, generally accounting standard must be applied depending on which aspect of business it relates to. So the four guidance or four areas of accounting standard. The four areas of accounting standard. Basically, there are a lot of accounting standard, but we can group and break them down into four: disclosure, recognition, measurement, and presentation. Everything that's any financial reporting standard, international accounting standard, international auditing standard, all the standards are talking about basically could be grouped into these four categories. If it's not talking about recognition of a transaction, it's talking about measurement, it's talking about presentation of it, it's talking about how to disclose it to the world. So when we're talking about recognition in accounting standard, recognition is actually concerned with that the item that we're about to disclose is part of the accounting record, that we ensure that every transaction within the year are actually input into the system of accounting of financial statement. That is, we should not allow any transaction to slip out of record. Then when we are talking about measurement, this concerns the value at which we record a particular transaction? What measurements are we giving to the particular transaction? And it is important for us to know that a particular transaction can have different measurements. We can have the initial measurement, and towards the end or at the end of the year, by the time we are finalizing the account, the measurement may change still on the same transaction. So financial accounting standard deals with these aspects too and regulates us on how to go about it. Let me give us an example. Let's say an organization purchases stock, listed companies stock on the exchange market at a particular period in the accounting year. And by the time they are finalizing for the accounting year, for a calendar year now, because the stock market is volatile and stock prices will fluctuate, at the end of the year, let's say the end of the year is December, we may need to look back and take the stock, and the final recognition that we are going to give will be different from the initial recognition of that same transaction, because it's either we have capital appreciation or the value has declined, and we need to make adjustment for that. So that is what accounting standard is talking about as it relates to the aspect of measurement. Also, presentation. Accounting standard talks about presentation. For example, the IIS one that I mentioned, one of the aspects of it is that every financial statement must have a comparative. That is, so that we can compare at least two periods together for easy assessment and analysis and following the trend. Last but not the least, we talk about disclosure. We will talk about disclosure. And when we are talking about disclosure wants us as much as possible to put more information out there for users of information to decide, to be able to make a intelligent decision, having gotten the financial statement that we've produced. So that is what disclosure is all about, and it is important that we disclose very well. So from GJAMES Associates channel, if you are yet to subscribe to us, please go and click the bell right away so that you will be notified when we release new videos. And subscribe is important to us, that you subscribe so that more people can be reached. Comment if you have any question, and we'll be glad to hear from you. From GJAMES Associate channel, we are value to life, we are value to your business.